And so the money kept pouring in, and the dollar started to go up, 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 up in value. Now, as the dollar went up, up, up in value, because the rest of the world was investing heavily here, right? He said the money was pouring in because of folks were investing here. The dollar is very high in value, very expensive. Does that make it easier or tougher for us to sell overseas? A lot tougher to sell. All of our goods, look at that. It goes from 100 to about 130 something. That means all of a sudden American goods are 1/3 more expensive. So it's tough for us to sell, and it's easy for us to buy. And that begins the massive trade deficit. And the deficits become so massive that Congress is about to enact huge tariff increases and override any potential veto of President Reagan. So President Reagan sends James Baker, who was then his Secretary of State, around and he says, look, guys, we better have some help here, otherwise you're going to face higher tariffs. And so what happens, everybody gets together at the Plaza Hotel. I want to say 1986, but it might have been 1985 in New York. And they agree to pursue policies to force the value of the dollar down. And that mainly means that any dollar value securities that the foreign central banks had, like United States Treasury securities, they begin to dump to force the value of the dollar down. See? And so the dollar begins to fall. You can see it works. But from your memory, in the long run, does it prevent the trade deficit from getting larger? No. Remember how it... So the dollar falls in value and it stays down here. And then all of a sudden, the dollar starts to perk up again with our stock market boom of the late 90s. Folks in the rest of the world start to send their dollars here. Send their funds here to buy our stocks. But when the stock market boom came to an end, the dollar falls again. So right now the dollar is pretty low. Question for you. Looking toward the future, what incentives do folks in the rest of the world have to either buy the dollar or sell the dollar? In other words, what might encourage folks in the rest of the world to sell dollars?
Risk to capital. Some kind of risk to capital.
Well, suppose, let me put it this way. What's happening to the outstanding debt of the United States being held by the rest of the world? It's going up, right? In other words, the rest of the world is holding more and more assets, American assets, like United States Treasury securities, real estate, stocks, bonds, whatever, correct? Now, suppose the rest of the world becomes disenchanted with all that. And suppose the rest of the world says, well, to what extent should we just keep accumulating this asset? Maybe it's time we should accumulate some other kind of asset. And if they therefore begin to sell their dollars because they prefer some other kind of asset, that is an asset denominated in something other than dollars, what will happen to the value of the dollar? It'll fall even further. Now suppose as the dollar falls in value, people say, wait a minute, the dollar is falling in value. This may be a bad investment to hold on to. I better liquidate my dollar investments in order to move into something else. Well, then the dollar will fall even further, right? It's like a stock market crash or any other asset bubble. People begin to liquidate. Now, if people begin to sell off United States Treasury securities, what happens to the price of Treasury securities? They fall. And if the price of Treasury securities falls, what happens to the interest rate? Rises. So there is some fear expressed by some that the dollar's fall in value, combined with the accumulation of dollar assets by the rest of the world, could someday lead to a liquidation of those dollar assets, a further decline in the dollar's value, a rapid rise in interest rates, and therefore a harmful effect on the United States economy. So that's the relationship between the value of the dollar and interest rates and an impact on the economy.